Hi, hello everyone. This is digital learning platform by the Department of Collegiate Education, Government of Karnataka. Welcome to my dear students. Myself Narsimhamurthy TN, an assistant professor and an in-charge principal, Government First Aid College, Medigeshi, Tumkur district, Karnataka. Today I am going to share a knowledge in the subject of accounting for managerial decisions, second chapter marginal and absorption costing. In this chapter today we are going to cover the topics of introduction, meaning, definition and features of marginal costing. Okay, let us begin with the class. So, first of all, we must know the introduction of marginal costing. Marginal costing is a technique of costing concerned with ascertainment of marginal cost of a product. Marginal costing is a technique of cost accounting which is concerned with ascertainment or finding out of the marginal cost or variable cost of a product is going to be produced. Marginal cost is nothing but the variable cost of a product. But in the sense, marginal costing is a technique or a tool or a device of cost accounting which is going to be ascertain or finding out the variable cost of a product. Marginal costing is a technique can be used in the combination of other techniques such as budgeting as well as standard costing. It is a combination of two techniques, that is budgeting as well as standard costing. Marginal costing is helpful in determining the profitability of products, departments, processes and cost centers at the time of finding out the profitability or the variable cost among the products, departments, processes and cost centers. The profitability by knowing calculating the marginal cost accounting tools is helpful to the management to decide the profitability of the production. While analyzing the profitability, marginal costing interprets the cost on the basis of nature of cost. It emphasizes on behavior of cost and impact on profitability. How the behavior of costs or various costs will impact on the profitability, it can be studied by the marginal costing. Marginal costing is a technique of costing oriented towards managerial decision making and control. As purely marginal cost accounting is a management tool. It helps to find out the profitability to the of a business concern. This tool helps to the management to take managerial decision making and control over the production or control over the cost which is going to be incurred. So afterwards we must know the meaning of marginal costing. First, before knowing the marginal costing, we must know the meaning of marginal cost. Marginal cost is the variable cost comprising prime cost and variable overheads. Marginal cost in the sense variable cost. It comprises the primary cost as well as variable overheads. In a broader sense, in marginal costing procedure, costs are separated into fixed and variable components. Whatever the cost will be incurred in the business is going to be separated or segregated into fixed as well as variable components. Only the variable costs are regarded as a cost of the products being manufactured. In this marginal cost, only variable costs are regarded as the cost of products being manufactured. The fixed costs are treated as period costs which will be incurred in the period regardless of the volume of output and are charged directly to the profit and loss account. Whatever the fixed costs are incurred is to be treated as period costs which will be incurred in the period regardless of the volume of output of production. It is directly charging to the profit and loss account. So marginal costing is a special technique which is concerned with the differentiation between fixed costs and variable costs. It helps to ascertainment of marginal costs or variable costs and finding out the effect on the profit of changes in the volume or type of output. So marginal cost accounting is a branch of cost accounting. It is a special technique which is going to be differentiated between the fixed costs and variable costs, and it is purely a management tool to take managerial decisions on the profitability. It shows the profit of changes in the volume or type of output of the product to the management. Marginal costing is a special technique of ascertaining the marginal cost or variable cost of a product. Marginal cost at each level of production includes the cost of any additional inputs required to the produce in the next level of unit. Then we must know the definition of marginal costing. According to Institute of Cost and Management Accountants, London, it defines, that is ICMA defines, marginal costing is ascertainment of marginal cost and of the effect of profit changes in the volume or type of output by differentiating between the fixed costs and variable costs. In this technique of costing, only variable costs are charged to operations, processes, or products, leaving all indirect costs to be written off against profits in the period in which they arise. So, according to Institute of Cost and Management Accountants, who are the experts in the field of cost and management accounting institute, that is ICMA London, defines that marginal costing is ascertainment of marginal cost. Marginal cost in the sense variable cost. It must be finding out by preparing the marginal costing tools and find the effect of on the profit of changes in the volume or type of output by differentiating between fixed costs and variable costs. So we must know that the effect of profit of changes in the volume or type of output. So if we produce 1000 units, what is the cost? If we find out the profitability if we produce a 10,000 units, so it is going to be studied in the marginal costing. In this technique of costing, only variable costs are charged to operations, processes, or products, leaving all indirect costs to be written off against the profits in the period in which they arise. In this technique, only consider variable costs which are directly charged to the operations or the processes or products and leaving all indirect costs to be written off against profits in the period in which they are arise. After knowing the definition of marginal costing, we'll move on to the features of marginal costing. Marginal costing is an effective tool to help management to take managerial decisions regarding the profitability, regarding the additional productions, regarding the additional expenditure which is going to be incurred for the additional production. So, let us know the features of marginal costing. First and foremost feature is marginal costing is a technique of costing which is used to ascertain the marginal cost and to know the impact of variable cost on the volume of output. The first feature of marginal costing is a costing which is used to ascertain the marginal costs and know the impact of variable cost on the volume of output. If you increase or decrease the volume of output, then we have to saw the variable costs also increase or decreasing. It studies the marginal cost, the impact on the volume of output varies. At the same time, it shows the how much variable cost, additional variable cost, if you produce more number of units, the additional variable costs are going to be incurred, or to cut the cost, it must be cut down the production or the output level also. Marginal costing is a special technique of analysis and presentation of cost data. It is a special tool to the management to provide an in detail analysis of cost data, as well as the after analysis in cost data must be presenting to the cost data to management. And all costs are classified into fixed costs and variable costs on the basis of variability. So, whatever the costs involved in the process of production of output, all the entire costs are segregated, are classified, are grouped into fixed costs as well as variable costs on the basis of variability. The another feature, that is variable costs alone are charged to production. Fixed costs are charged to period costs and recovered from contribution. Whatever the variable costs incurred is directly charged to the production level, and fixed costs which are are treated as period costs. All fixed costs are running costs which is happened at the period to period of time. It must be charged, fixed costs are charged to period costs and recovered from the contribution. And another feature, the valuation of stock of work in progress and finished goods is done on the basis of marginal costs. Whatever the valuation of stock in the process of work in progress and finished goods, it should be valued, the remaining stock will be valued on the basis of marginal costing. Selling price is based on marginal cost plus the contribution. Profit is calculated by deducting marginal cost and fixed costs from the sales. Whatever the profit earned is to be, profit is to be calculated. How much the expected profit or anticipated profit will be calculated by deducting marginal cost and fixed costs from the sales. Cost volume profit or break-even analysis is one of the integral parts of marginal costing. The CVP analysis or break-even analysis or cost volume profit or break even analysis is one of the integral part of marginal costing. The profitability of product or department is based on the contribution made available by each product or department. Whatever the profit earned by the each product or each department is based on the contribution made available by each product and the department. So this is the end of the features. For more reference, kindly refer the following books. So thank you for the viewers for your patience listening. Kindly subscribe our YouTube channel Learning Platform by TNN. Thank you one and all.